what are the questions that investors ask you when you talk to them? Many people are afraid to talk to investors because they're afraid that they won't have answers to those questions. But it's easy. You have just to get ready to answer any question about your company, and then you will be able to talk to any investor. So what are the areas investors might be interested in? First is what you do, which problem you solve, how your solution works, what you propose, what's your offering. So anything about what you do. If it is not their area of interest, they won't continue talking to you. If it is their area of interest, then you might have a conversation. Then they ask about the team, because startups often fail, startups often pivot, startups sometimes succeed, and it highly depends on the team, whether the team has a great expertise, experience in the past, whether they do have all team members and all the skills which are needed, and whether they are motivated enough to continue in cases of hard times. Then definitely they ask about the business case. Basically, what are the business cases, how to get money, how do you plan to earn money, how do you plan to make an exit, when do you plan to do next investments, and so on. So everything related to money. And then coming other questions about the marketing, go-to-market strategy, and so on. But basically, if you know how you want to sell, if you know how to do the product, and if you can imagine in your head how your company will develop, then you will be able to answer any question. And if not, you can always say that you need to take time to answer the question in more detailed or more precisely. To continue some of the questions, I'd like to point out are first the founder's background. Founder's background can tell to investor your expertise, whether you're from this area or from another area, your experience in leading the team, your experience in managing problems, and it doesn't always matter if it is in the same area or if you have been doing something completely different. Just show your soft skills, your hard skills, show how motivated and how happy you are to lead and to continue this work. Because investors want to make sure that you won't just spend their money and go away. Next question is unit economy and company economy. You have to be able always to calculate and to say, okay, this is something that I offer, a service or a product, that's how it costs and that's how much I will get for it. It might be that initially you won't get too much money, or maybe that initially overall your business will be negative and not profitable, but that's okay. What you have to be able to show is when will it become profitable, and that's really important. And that's why you have to show unit economy and show that at least if you sell 10 units, 100 units or 1 unit, you already make a small profit at some point. And then all what you need to do is to scale that with the help of money you are searching for. Next question is a progress. So basically, at which stage your product is, at which stage your sales are, do you have any clients or not, do you have any patents or not, do you have something to prove that your business is actually capable of generating money, of generating revenue. If you can show this, that's a really good sign and it really helps to get investment. Important thing for investors is also when do you plan to get a next investment, or even more precise, when do you plan to have a next investment round? Why is it important? Because it gives a milestone and a timeline of when this investor can expect to get part of their money back, and or when they can get a confirmation of the updated valuation of what you do. Because if you get some investment right now, you want to be sure that in 2 years it has doubled or tripled or not, right? And how can you do that? Only when somebody else believes in your company, believes in this business, and gave you money using a different valuation, a bigger valuation. Only then you, as an investor on this round, can more or less be sure that your money are safe. And often, when investing, investors are given a possibility to sell their shares first on next round of investment. And that's what they often do in order to ensure that their earnings are also safe. Do investors ask different questions depending on what stage startup is? Yes. On the earlier stages, the only thing that startup has are founders and the team. So basically, founding team, core team, management team is a key and is a core to success of the startup. That's why many investors focus really much on that, and they try to guess basically whether this team is capable of bringing that idea to the end. The idea itself, it also matters, but it has much less focus than it will have on later stages. On later stages, though, especially on stage A, for example, or later seed, really big focus is on the business result and scalability and on the unit economy. Because at this stage, you have to show that you have found your market fit, that you have found a business case, that you have found a place where you can earn your money, and you need more money, but just to develop and to scale the success to the new heights. Do different investors ask different questions? That's also true, but it differs more for different types of investors, because most probably angel investors will give money to you, and then they will ask questions about you, if they can trust you, and or to your idea, and then they will believe or not believe in your idea. While VC funds or professional funds, they will have a big list of questions, while professional funds will have a more formal list of questions, and first you have to pass those, and then you have to pass everything else, as I mentioned before. Let's now imagine ourselves on the side of investors. Why do they invest? What are thoughts in their head before they give you money? First, let's start with the question, why do they invest? They invest because they want to give you some money, wait, and get more money, right? They want to increase the amount of money they have. When you think about this, you understand that there are many ways how this can happen. So next question you have to ask yourself, who are competitors who compete to get access to that money? And this is very interesting because your competitors are banks who propose deposits, and that's a very safe way to invest, but that's a way that gives the lowest return. They can invest in bonds, which is maybe more, maybe less safe, but it definitely gives a higher return rate. They can invest in stocks of publicly known companies, and they can invest in funds, because those VC funds, they also get money from somewhere, right? And people who invest, they basically can invest in funds where there are professional managers who will later invest in you as a startup. And then there are different startups. So when you think about investment, from the investor perspective, you have to understand that there are different ways how to increase amount of money from the investor point of view, and you have to give a way, and you have to make sure that investor will, with high probability, get much more return than using any other instrument. Only then it makes sense for investor to invest. Otherwise, why to risk? An often question which startups ask are, what happens if I fail? Do investors expect every startup to succeed? Good answer is no, because investors understand that out of 10 startups, 3 will fail, 3 will give somehow nice result, 3 will give a better result, and hopefully only 1 will be very successful startup which will give a great return, which means that it is a responsibility of the investor to choose and to diversify the portfolio. And when investor invests, he takes risks and he fully understands that you might fail. Now, when I say diversification, what it actually means? It means that when investor wants to invest, he can invest in different companies, expecting that if one industry or one company will fail, then another company will succeed. It might be that he invests in big companies and small companies. He might invest in different industries. He might invest in different stages of startup. There are different strategies might be used, but the main idea of diversification is to put money in different areas so that averagely it will be more safe than to put in one place. One interesting term to know is smart money. Smart money is when investor gives you not only money, but actually something else. His connections, his knowledge, his mentorship. It is a good idea to search for smart money rather than just for money, because investors have really good connections. Yeah, they do have money, they got it from somewhere, and they have a good network. They are talking with other investors, they are talking with other startups, they are talking with other people. And if investor can give you all his support, then you have much more chances to find clients, partners, or great deals in order to make a startup more successful. And for the investor, it is more interesting to help startup to be successful, because in that case he will be able to get his investment and get it back and get more earnings on that. Interesting situation might happen that one investor might invest in two very similar companies, maybe even competitors. Is it a problem? Might be not. Because from one side, investor might diversify his portfolio if he believes in the area, but he doesn't know which company will actually succeed, because there are different teams, because there are different approaches, and one approach might be successful, another approach might be not. So don't be scared about that. But it might also be not so good if investor will share information between them and share secrets between them. But in most cases this doesn't happen. Also, it is a good idea to speak explicitly with investor about that. So let's summarize. When investor wants to do an investment, he first analyzes how safe it is and what are other ways to multiply his money. Then he analyzes the risk, and then he checks the timeline. I invest now and I expect return of my investment in a year, in 2 years, 3 years, and how much there will be in this time. And then there is a risk analysis, which has to show what might happen and what might not happen. Investor might diversify, and he might give or give not you some smart support together with money, which might be networking, partnership, or something else.